The Milken Institute Global Conference is the culmination of the important work our centers do throughout the year and helps inform our agenda going forward. Each of you participating represents extraordinary expertise, an ability to mobilize significant resources, and a sincere desire to be a force for good. And for that, we could not be more grateful. It is my honor to formally acknowledge and thank the group of people who make this event and all the great work we do possible, our supporters.
And now, please welcome our moderator.
Hello, and welcome to the final day of the Milken Institute 2020 Global Conference. My name is Mike Pivovar, and I have the pleasure of moderating today's first session with our all-star lineup of panelists to discuss the credit recovery from the COVID-19 crisis. To what extent is it uneven, unequal, or uncertain? Our four panelists are all leaders at top global alternative investment management firms that invest across a broad range of alternative investments, including credit and distress. First, I'm pleased to welcome Ilfrin Carstairs, partner, co-CEO, and chief investment officer at Barday Partners. Next, I'm delighted to welcome Leslie Cowan, management committee partner at Fortress Investment Group. And next, I'm pleased to welcome Joe Nagar, partner and head of structured products at Golden Tree Asset Management. And last but certainly not least is Jim Zelter, co-president at Apollo Global Management. We're so fortunate that they could join us today to discuss this timely topic. To frame our discussion, I want to remind everyone what the world was like in February and March earlier this year. As the coronavirus spread throughout the world, there were many unknowns about the health effects of the virus. How does it spread? How contagious is it? How fatal is it? Are public health systems adequately prepared? When will safe and effective vaccines and therapeutics be available? There were also very many unknowns about the resulting economic effect. How long would government-imposed travel bans and lockdowns last? What would be the size and composition of fiscal stimulus packages? How would central banks react? And to what extent would lawmakers and regulators enact debt forbearance, forgiveness, and other relief programs? The credit markets reflected all these concerns, fears, uncertainties, and realities. Now that we're at least getting some clarity to some of these questions and macroeconomies are starting to rebound, the credit markets are starting to recover. But there are remaining questions about who is actually participating in the recovery. Conversations about which letter best exemplifies the shape of the recovery started out with, is it a V, a U, or a W-shaped recovery, have increasingly focused on a K-shaped recovery. Some households are participating in the recovery, some are not. Some industries are participating, some are not. So let's get our speakers' views on this important topic. Ilfrin, let me start with you. You have deep expertise from investing through many credit cycles. While they are all different, and the COVID-19 crisis was so different, even compared to the global financial crisis, that it presents new challenges as well as opportunities. Where do you see the opportunities?
Thanks, Mike, and thanks for hosting the discussion. I think you gave an excellent intro there to what we're all thinking about in credit markets. I think, I would start talking about opportunity in a way by reflecting on what sort of cycle we see in front of us. And as you referred to there, cycles are really one of the key things that we've worked through in our 26 years here at Barday. It's really our entire business is constructed around alternative credit and cyclical credit and how it works through a cycle. I think when you look at this one, I'd follow on a few of the points you made there in your intro. It's really a seismic shift. This is a very big cycle. This is not a small change in the credit environment, and those things tend to follow something of a predictable path, even though what happens literally to each part of the market can be quite different. Maybe if you could pull up my slide 5 here. As much as anything, I think it's important to just recognize that you're in a big cycle, and that the way the phases play through in a credit cycle is very important to the type of opportunity that you look for at different points in time. I think these things are very complex, but they boil down to some simple points. If you have a very good team of fundamental credit analysts, you have the ability to do very good credit selection, and you have the ability to look across a number of different markets and apply that trade in various different parts of the credit markets. I think what we'll have in front of us here is a couple of years of very good opportunity across all sorts of different credit markets. I kind of start in a way with that point on slide 5 of where we are. I think if you look at the phases of the credit cycle that we see in front of us, and this, of course, will play out differently by different credit asset class and by different marketplace. But I think we're still very early. You referred to a lot of the uncertainty that we see out there affecting credit. We've come through that what I would call the chaos period at the beginning of this cycle, but we're really still somewhere in the early to mid part of the cycle, and that to us says not just what opportunity is out there, but what type of risk do we want to take. And there's sort of a happy confluence, I think, at this point in credit markets, where, in some sense, for all the folks on this call, there's a lot of demand for our services. There's a lot of demand for credit, be that in the form of new capital that needs to go into bolster liquidity, be that in the form of problem solving, rescue capital, those sorts of things, or even be that in the form of deleveraging capital, existing lenders looking to get out of existing positions. So there's a lot of demand for our services. And so, it's a point in time where, I think you don't have to take on so much uncertainty. You don't have to take on so many bets that require you to really be precisely right about what the cycle is in front of you. And what do I mean by that? Well, we're still very focused here at Vade in looking for things that have great downside protection, that aren't, precisely dependent on the path of the economy or the path of a company's fortunes from here. And where we can really lock in that margin of safety in what we're doing. And thankfully, just given the level of disruption that's out there, we're seeing that across a lot of the different parts of our global platform. I'll touch on a few of them just to give you a flavor of the things that we see as most interesting right now. I will say that will evolve a lot, and as we flow through this chart here, as we flow through the phases of this cycle, what we do, even within these existing opportunities, I think will change a lot. But let me hit a few of them for you here up front. First, I think there's still deceptively very good value in the traded credit markets. There's a lot written about how much markets have rallied. There's a lot of focus on things like Fed intervention and the like. But I think there's still very good value in traded credit markets, and very good value in both corporate credit and certain parts of the structured product market. And I think you can still see quite significant dislocation as well, because you have very big companies, companies that have a lot of degrees of freedom, and companies that have access to liquidity with very good business models that still have a lot of demand for credit, and where you can buy their securities and buy them actually with quite good duration at significantly wider spreads. And in certain cases in the market, you can find those dislocations where even equity market caps and enterprise value has almost fully recovered from where it was pre-COVID, but you're still getting quite an elevated spread. And we see that, as I said, across both corporate markets and structured product markets. Now, it's not the opportunity perhaps that it was in the second quarter of this year, but there's a lot still out there to do. And it's a very, very heavy credit selection, business model selection, and individual CUSIP selection process that we go through right now. But we continue to find a lot to do there, and things that I think have great downside protection, but also continue to offer you that more equity-like return. The second point I would make, two of our really big focus points in private credit markets, clearly very disrupted at the moment. The financial services and consumer finance space on one hand, the real estate space on another hand. I would say there, we're finding a lot to do in our credit origination businesses, and very, very simply put, there, I would say you've been able to really hold on to that absolute level of return that you were seeing in credit origination prior to the crisis, but against a very much lower interest rate environment. And of course, a lot of what we do in that space is originate and then generate different returns through things like the securitization market. And we have an example there, I think it's slide 7 in the of how we look at the CRE market right now. Slide 13. We're able to originate, if you could bring up slide 13, we're able to originate really still at the same level of absolute return that we were originating in CRE prior to the cycle hitting. But now you're able to tap the capital market and use financing that's really benefiting from that big move down that we've seen in rates to generate really quite interesting equity-like returns on that mezzanine piece of paper through securitization. And so we see a lot there, both from our own origination network. We have a big origination team that has everything there, from origination through servicing, which we own in-house, and we're seeing a lot in both of those spaces. I would say both what we're originating ourselves and also what we're able to buy off the market for deleveraging. And then I'll touch just briefly, our Asian lending business, also seeing a very deep pipeline out here in Asia. Of course, I'm sitting out here in Singapore, and Asia really benefits from a couple of trends in terms of that supply-demand balance. Of course, being hit by the same forces as we've seen in COVID, but just systematically, you have less market provision of credit out here, and you have less alternative credit. So anytime there's some disruption in the market, we tend to see a real elevation in the price that you get paid for credit in our Asian origination business. So I'll leave it there. There's a flavor of some of the things that we see as most interesting.
Thank you, Elfrin. Leslie, describe the opportunity set you're seeing at Fortress. What does a road to recovery look like to you, and what's your game plan?
Sure. Well, first of all, we're obviously meeting at an extraordinary moment in time, not just for funds like ours or for the markets in which we participate, but for millions of people dealing with the devastating impacts of the global pandemic that literally no one could have imagined less than a year ago. Recognizing that, I'd like to start by thanking the Milken Institute for all that they're doing to help accelerate progress toward a resolution. We believe this crisis and recovery will really underscore the critical role that alternative asset managers like Fortress and others on this panel must play in times of market dislocation. Never really in our lifetimes have we seen a more urgent need for capital and financing solutions across such a broad array of industries and companies simultaneously. Virtually overnight, revenues went to zero or near zero across literally thousands of businesses that depend on physical presence and the ability of people to congregate, such as hospitality, transportation, travel, sports, and entertainment, etc. For those investors able to fill the gap where traditional financing sources are unavailable, we see an enormous opportunity, and in fact, really almost an obligation, to help real people and real companies navigate through this period of unprecedented challenges, distress, and uncertainty. For a select handful of asset managers, those with the experience through cycles, with the resources needed to underwrite a range of asset types, and the ability to intensively manage investments, there's a real and exciting opportunity to generate outstanding returns for our LPs. If you don't mind, please put up slide 18. To be more specific, we see the current crisis taking shape in 3 phases that we came up with in March when this all arose: forced liquidation, illiquidity, and reconstruction. Phase 1 is forced liquidation, which was really defined by panic selling and virtual market paralysis. This phase was fleeting, lasting only for the extent of March and April, and was really characterized by our focus on the public markets. In that time, we were able to mobilize our team and deploy a lot of capital quickly in deeply discounted public securities, including broadly syndicated bank debt, high yield, and structured credit, where we felt great about our downside protection. Phase 2, illiquidity, is the phase in which we are now, during which borrowers need cash and creative financing solutions to shore up their balance sheets needed to provide runway to get to a better functioning economy. Examples that we think about include rescue financing, the purchase of discounted assets, hard money loans, and opportunistic sale-leasebacks. During this phase, there is some balance between public and private market opportunities. Phase 3 is what we call reconstruction. Here, we have an opportunity to clean up orphaned assets and to help companies come back online after many months in survival or hibernation mode. During this phase, we expect that private market opportunities will generally be more attractive than those in the public markets, and we expect to emphasize idiosyncratic transactions. We think the path to recovery may take in excess of 2 years. We certainly don't have a crystal ball, but we are prepared for phases 2 and 3 to remain fluid. What we do know is that our resources, experience, and framework will allow us to adapt to the inevitable challenges on the road ahead.
Thanks, Leslie. Joe, what specific sectors and regions offer opportunities at Golden Tree, and does the current crisis it be narrowed down? Does it need to be narrowed down beyond a macro level to an idiosyncratic approach?
Great, thanks, Mike, and thanks for having us. And it's nice to be on this panel with such panelists. I think I really thought that the way that Ilfrin and Leslie showed sort of the phases was actually quite nice. At Golden Tree, we, like them, like to focus on really where the best opportunities are. And it shifts. Really, I think the punchline is sometimes it's in the private markets, sometimes it's in the public markets. Usually during the midst of a dislocation, like we saw in March and April, the public markets are the fastball and the easy place to kind of go to. For us, legacy RMBS, for example, was just a very forced selling situation where you had, mortgages that had 30% home equity in them that have been paying for 14 years with good borrowers that literally dropped 50% in value, even though they were fundamentally well protected. And that was a great opportunity during March, but also fallen angels, were great examples. Like Kraft dropped, something like, you could buy the Kraft bonds in the 80s with 20% type of total return. We were able to deploy, I think it was on the order of about $3 billion of capital in fallen angels, and still see some value in that, and have about $1 billion that we still own across our strategies. So the public market fastball is during that dislocation period, but then it shifts kind of as was just shown, and then you start to have the opportunities today are driven by other areas that are uneven, that still have not recovered yet. Energy is a sector where the debt markets are pricing in a very different outcome than the forward curves on oil, and quite depressed. We're finding good long-lived assets that we believe will perform well, yet still being able to purchase that and create it at 25% of net asset value. That's one area. Other areas include the Latin America, for example, has a lot of uneven stories, since we're talking about that topic, where you have places like Argentina, which is very idiosyncratic, going through a major restructuring, but can offer quite a bit of value, or even maybe something more on the run. One of the largest issuers in the emerging markets, Pemex, where it's a systemically important company to the country. It's owned by the country, generates something like 20% of the revenues. Yet we see, for example, the Pemex debt trades 500 over the sovereign, when in effect it really is the sovereign. And that offers a lot of convexity. One way that we try to show where we are today in the markets, if you put up slide 20 to try to complement the previous slides that were shown up, you might think, looking at the equity markets, that things are sort of rich, but credit actually has still got a lot of value. One of the ways that we look at where we are today is by looking over, sort of statistically, where are we over long periods of time? And depending on how you look at U.S. equities, we're certainly on the higher end of ranges, depending on what metrics you look. But with regards to credit broadly, spreads and high yield are in the mid 400s. That takes us into the 47th percentile, give or take. Now we were at the depths of around 6th percentile during March, but still offer quite a bit of value. And when you think about investors, and investors are thinking about how to make money in this low interest rate environment world that we're in, you can find good margin of safety, good equity-like returns, quite frankly, in credit. So it's an unusual combination. And from an investing perspective, one of the most interesting times to be doing it because of all the different dislocation under the hood.
Thanks, Joe. Jim, Apollo invests in a number of different industries. And Joe was talking about how the uneven sort of recovery affects debt versus equity. I'm interested in your perspective. In a world devoid of yield, where are the most attractive opportunities in terms of industry? Which industries will bounce back? For example, which ones are going to be in the upper part of the K of the recovery, and which ones are going to continue to have challenges, decline, be on the lower part of the K?
Thanks, Mike. I feel like I'm back in grade school where the Z was always at the end of the line. So I have to be creative after my three other panelists here. But I would say how I think about this crisis we're in right now, or this period. Back in 2008, the crisis was really at the intersection of residential mortgages and the mainstream financial institutions with regard to funding and liquidity. And when you go back to March of this year, we were entering 10 plus years of a credit cycle. The consumer was in relatively pretty good shape, but I think when we look back at what's happened, and I agree about the three stages, and we've coined that here at Apollo as well. But when I really sit back and think about the firm and how we're thinking about things, a few things come to mind. First of all, if you go to slide 25. There has been a tremendous, this slide actually surprised me when my economist showed me a few weeks ago, but the amount of elevated zombie companies coming into 2020, you can see this is public U.S. companies with interest coverage less than 1 time, which is actually a shocking number considering the slide that was just put up regarding equity valuations and credit. So I do share the view that there are opportunities in credit. I think there's a few themes that we have followed, and I would say big picture to specifically answer your question, we are finding opportunities broadly in commercial real estate and believe that there's going to be a multi-year opportunity with how you navigate senior, junior restructurings, yield, and a variety of opportunities, which I can dig deeper into in that space. And big discrepancies between the equity and the debt markets and how you apply different valuation metrics around public REITs and private securities, which we can get into. But broadly speaking, commercial real estate, large intersection of dislocation, some liquidity, some restructuring, some insolvency, and some distressed. The other broad industry, I would say, is the aviation space. 20 plus years of global macro GDP plus growth, consumer wealth around the globe, travel, India and Asia and thereabouts, a massive amount of forward flow in terms of productions by really a duopoly between Boeing and Airbus. And you have the leasing companies, you have the finance companies, you have the Asian banks, and then finally you have the airlines who have all restructured. So, we have found many ways, depending on where you are regionally and globally, how you can play the broad aircraft, air finance, and airline recovery. Sometimes you want to be in a low-cost carrier supplying planes. Sometimes you want to be in a well-established carrier with mileage plus programs, probably avoiding some of the top-end business travel because of what's going on with the consumer. But so broadly speaking, aviation, aircraft, airlines, massive power sector of opportunity. Same with commercial real estate. The other points I would make, certainly, and the other panelists have just talked about it, but how I see the cycle, what's happened is really was follow the Fed. The Fed gave you the playbook. They took out the 2008 playbook. It was a playbook that was relevant to 2008, probably not quite as relevant to 2020, but that certainly meant go to the top of the capital structure, highest quality securities, discount, buy them quickly. But when you look at where spreads are today, and I would echo some of the comments, we still think being in the higher quality names is a benefit. So, we structured a very interesting deal with a large Middle Eastern company over the last 2-3 months. They had a variety of balance sheet assets that they really were not efficiently using to return capital, and we created a very interesting long duration, triple net lease, credit tenant lease type of structure. Very attractive when you look at it was a single A rated asset. Very, very interesting yield, and again, long duration. So, I would say that, between aviation, between commercial real estate, following the Fed, understanding the real differences of this crisis versus others. And I would also say that, we have a view, if you go to slide 26, there's going to be a wide dispersion between companies that actually are back and stay challenged versus that will stay strong. And, it's our view right now that, companies focused on a lot of liquidity needs, but in 21 and 22, there's going to be a whole host of solvency issues that come back because we don't know a lot of questions about consumer behavior. We don't know questions about how people are going to be spending their money. And again, while the consumer in the U.S. is in a good standing overall as they came into this crisis, and residential has been a strong asset class, how people are spending their marginal dollars with a consumer-driven economy is really going to be the key to investing in 21 and 22 and beyond.
Jim, let's stick with you and shift from industry sectors to geographic sectors. So Ilfrin talked about opportunities in Asia, and Joe talked about opportunities in Latin America. What do you see as the next phase of private credit in both the United States and Europe, and its scale required to succeed?
Well, I think in the U.S., and we've been pretty public about this, we've seen what's going on in the broadly syndicated market, which and all of our panelists are major players. We've seen what's going on in the middle market sponsored lending space. And, there's a few key themes. The regulatory challenges are going to continue. The rating agencies are going to be under more pressure to probably, stiffen their guidelines in terms of triple C and single B baskets. So in the U.S. and Europe, we definitely see an opportunity for some portion of the $2 trillion plus broadly syndicated market to be a solution is large cap and large corporate origination. There's been about a dozen transactions over $1 billion in the last 12 months. We've done half of those here at Apollo. New Fortress Energy, YRC, New Media were many of the ones we were involved in. And the reality is the syndicated market is a great place for many, many companies. But I would argue 10, 20% of those, between covenants, between ratings, between structure, between current needs versus market depth, that there's an opportunity for large scale deployment, probably at better yields and probably at better covenants than there are. And I think it will be the third asset class in direct origination over the next 3 to 5 years. So that's the first one. I think that's going to happen in the U.S. and Europe. In Europe, I guess if you could put up, I think it's slide 27, actually 28, excuse me. The reality is in Europe, the banks still, it's the complete converse of the U.S. They control 80% of the loans on their balance sheet. In the U.S., it's 20%, hence the IG and high yield markets. And as a result, several hundred billion of losses will be on these balance sheets. So between using your capabilities of buying assets from these institutions, or also providing debt solutions for companies wanting to grow, which there are many that are, whether it's in France, in the UK, in Luxembourg, in Scandinavia, many opportunities to bring this playbook. So that's really the playbook in the US and Europe. I would also say, and I'll let others comment after I have a few words, but basically, I do see interesting opportunities in Australia. The Royal Commission really came down quite harsh on those banks. A variety of opportunities in the consumer lending space and the commercial real estate space in Australia, and obviously India. Probably one of the ground zero locations in terms of what's happened in terms of dislocation and lockdown. but with the Reserve Bank of India and their rules, and certainly a tremendous amount of opportunities in those locations. So I probably prefer the U.S. and Europe, but certainly between Australia and India and other parts in idiosyncratic opportunities, Asia is also a focus.
Thanks, Jim. Ilfred, I want to pick up on that, where Jim mentioned there are good opportunities in Asia, which you talked about, and specifically he mentioned India. I know that Varde, you all are doing a number of things in India, and you all are a global company. You're based in Singapore. You're close to India, so I'd love to hear what you're doing in India. And also, just given your location in Singapore, one of the early countries to experience the COVID crisis, how did you benefit from that? It's sort of an early warning system and prepare your business for that.
Yeah, I'll take the second question first, Mike. I think in some sense, being in Singapore in January, February is really less important than the fact that we've been here for a decade. And why do I say that? We've run a very global business here at Varde for a long time, and so the preparedness that you have as a result of that, and the platform that you have as a result of that. Not that we were sitting here saying, "Hey, one day this will see us through a pandemic," but it was an enormous asset for that because we've been used to be operating virtually and dealing with each other over long distances. We've never built our different regions as satellites. We've built them as fully functioning operations. And so that has given us real flexibility and redundancy in our operations around the globe. And so, in some sense, to steal the question a little bit, the biggest deal for us is the fact that we've been global for a long time and we've been used to dealing with the constraints of that. You have to be honest in some sense about the early warning point. I think here in Singapore, the level of rapid response and I guess the level of adhesion to the rules that came into place in terms of dealing with the crisis, it could almost have given you a false sense of security, I think, early on in this thing. So for us, it was really that global element and the fact that it helped us to operate quickly and quite seamlessly in the environment. Of course, a very tough environment, but I think we handled it as well as anyone. And then just to pick up on your question about Asia and India in general, I made a couple of these comments in my earlier answer. Asia is a huge focus for us, and we've talked about it several times on this panel. And that's for a couple of quite structural reasons out here, which I touched on earlier. One, it is a region with enormous demand for credit, either through growth or through the fact that there's just very credit-dependent industries out here. A lot of real estate, a lot of heavy industry, and those types of things. So a lot of demand for credit. And in our view, just very poorly supplied in general. I'm not talking about in this crisis, but in general, because when you look at the size of the traditional financing markets, the high yield market, the bank debt market, and the like, they're really a fraction of the size of what you see in North America and Europe. And so that kind of systematic market credit provisions not there, very fragmented by country. And then on the other side of the equation, you just haven't seen that depth of development of our industry, of the alternative credit, the private debt, mezzanine markets, and those types of things. And so you tend to just systematically have a supply-demand imbalance out here for credit, and it tends to be filled by the equity markets, either the vanilla bank debt market or the equity market. So there's a big gap in between. If I comment just specifically on India for a moment, and our slide here, pull up slide 14. It's a good slide. One of the things, unfortunately, in India, if you just pull up slide 14, one of the things, unfortunately, in India, this is a bit of a triple whammy for the Indian credit market, the pandemic, because before that, you had an almost total shutdown of the shadow banking industry there, which was a very important source of credit. And before that, over the past decade, really, you had an enormous accumulation of NPLs in the Indian banking system. And so sequentially, three of the big sources of credit, or three big problems for the credit industry in India have occurred: the NPL problem, the shadow banking problem, and now the pandemic. And that's, even for us, required us to shift what we focus on in the country. Earlier on, we did quite a bit around that NPL opportunity. We built infrastructure on the ground there, opened our own office. We have our own team on the ground there. They were very focused on that distressed opportunity, but as things have evolved, I would say, really you just have a wonderful opportunity to lend money and lend it in quite a different way to what we see globally, which is you're not forced so much to take a bet on individual companies that are exposed to issues of the COVID crisis. Because there's such a dearth of credit in the country, you're able to lend against really high quality collateral, really to blue chip borrowers, not the sort of borrowers that typically deal with the alternative credit industry, because of that supply demand imbalance. And so, of course, there's jurisdictional risk, and we mitigate that, by a heavy investment in our own team, heavy investment in things like dedicated joint ventures that we have in the country. We have a joint venture there with one of the largest financial services firms, at Dealer Capital. And we mitigate that jurisdictional risk. But I will say, you're really getting paid there now just an enormous developing market premium for what can be structured as really developed market risk. And we're really quite excited about the opportunity to participate in providing that credit, for growth and to perfectly good assets and companies in that country. And of course, as Leslie mentioned earlier on, it's one of the beneficial things I think we can do to help repair things this crisis.
So Leslie, let me go to you next. Fortress has a reputation for complex investing. Can you elaborate on your capability?
Sure. Really, in a lot of ways, the credit business at Fortress was designed from the beginning to be able to tackle the most complex situations. We actually love complexity. We can pursue liquid securities as low-hanging fruit when the opportunity presents itself, as it did in the first phase of this crisis in March and April, by picking up publicly traded debt and portfolios at fire sale prices. But in our view, complexity, the ability to understand it, to underwrite it, and to monitor and manage it once an investment's been made, are really the key points of differentiation between the haves and have-nots among asset managers today. We embrace complex deals that other people shy away from, which gives us a competitive advantage in allowing us to drive terms and generate strong risk-adjusted returns. We really like to be involved in situations where perceived risk is high, but either because of our expertise, infrastructure, or insight, we deem the actual risk to be lower. This dovetails quite well with the environment that we're in now, which is certainly creating a lot of messy and complex opportunities. One good example of the type of complexity I mean is that we've been hired on a number of occasions to take over or co-manage the books of competitors facing asset liability mismatches. This entails underwriting that sometimes involves very large and very diverse portfolios that may have a mix of asset classes, a multitude of underlying owners, a variety of servicing platforms, multiple jurisdictions, and even active litigation. We also invest in transactions with complicated capital structures with a variety of underlying holders and relationships that need a lot of broad experience to be untangled. So let me talk a little bit about what we believe it takes to pursue such complexity. First, you need the collective experience to source transactions and price them correctly. I was among the first half dozen employees in the Fortress credit business. Our leadership team has worked together for several cycles, beginning with the recession of 2002. We're focused on properly valuing underlying collateral, assets, and cash flows. We're often able to apply specific knowledge of different asset types and structures because we have great depth of expertise and experience. As an example, our ownership of a variety of servicers provides us with perspective in such asset categories as real estate, transportation, and non-performing loans. At the end of the day, though, we rely very heavily on our underwriting and purchase price to provide us with a margin of safety for our investments. Second, we emphasize transaction structure. On the public side, we have to assess what the fulcrum security is and determine from the credit documents what our rights and risks are. For our originated transactions, on the other hand, we design structures that are intended to protect our downside and give us the chance to improve the outcome if the business plan goes awry. Third, you need the proper infrastructure to deal with this labor-intensive business. If you're going to roll up your sleeves and work through messy situations, you need great people and a lot of them. We have over 500 credit professionals, of which 115 are focused exclusively on asset management. We also have affiliated servicers globally that manage over $200 billion of assets in 10 countries. Collectively, our asset management effort to maximize the net present value of our investments, to get our money back, and to generate profits. I realize all that does sound like a lot of work and expense, but we believe strongly that the potential rewards for being positioned to take on complex situations can be really very substantial. It's what we do day in and day out, and we wouldn't have it any other way.
Joe, Golden Tree has a long history in structured products. So talk about how you're approaching new strategies, new structures in an attempt to generate a rate of return.
Sure. Thanks, Mike. I think for us, the range and rhyme are probably the best way to describe how we think about the world, and structured products are a great example of that. Thinking back to some of the previous dislocation periods like '08 or 2011, the opportunity set shifted. '08, CLOs were sort of, I think, one of the poster childs for great opportunities, oversold. In 2011, European opportunities were really quite interesting because of the Eurozone crisis. And we saw periods of time like in 2016 or even end of 2018 or beginning of 2019, where different sectors were hit more or less. This time, the most obvious sector was that legacy RMBS in March and April. But I think what's really, what I mean by range and rhyme is the rhyme today is really that you've had, kind of this dislocation. But the range is really where you can find, and you have to have, I think, to identify and force rank the best value. Right now, what we think some of the best opportunities are really coming from being able to look at private credit markets, maybe like manufactured housing loans or Italian salary loans in Europe, or think about private student loans. These are all sectors where there are banks or owners of really good assets that are motivated sellers, and that tends to be actually a common theme for really good investment opportunities. Good asset, weaker hands, and that's where we're trying to go. Being able to securitize a little bit like Ilfrin kind of described is actually a really nice way to often create and change and transform the risk that you own into something that can be quite nice and often create a good exit. If you put slide 21 up real quickly, this is an example of doing a private student loan asset-backed securitization. We like private student loans because you can get very good FICO scores, really good credit, as opposed to the government student loan market. Private student loans can be underwritten for your colleges, often have co-signers, and the securitization market right now is actually open and provides very attractive non-mark-to-market, non-recourse financing that can generate good mid-teens or high teens type returns on a very, very well-performing asset in a lot of different market cycles. So I think from our perspective, it's really kind of trying to be thoughtful about where the rhyme is, and actually having sort of range to be able to attract those investments. Structured products has been an area we've done it, but it goes to our broader investment strategy. Golden Tree is one of the largest privately owned credit managers, and we have sort of worldwide capabilities both in the U.S. As well as in Europe, and then we have emerging markets. So it's really trying to source those investments and force rank the best ones in the environment that we're in today.
Joe, let me stick with you. Jim suggested following the Fed book, given the large amount of asset purchases that the Fed is doing. How dependent is the current market outlook on continued central bank?
It's a really important macro topic, the areas I chair our risk committee as well. So I spend a lot of time thinking about the relationships between fiscal and as well as the central banks. And the central banks are the largest financial actor in the world. They always have been, but it's become even more so. And they do play a very important role and are going to continue. The balance sheets have grown dramatically. And you also have a regime shift. There's been a lot of new ground that's been covered over the past 10, 15 years in terms of what the range is of central banks. And if you look at each crisis as it happens, the central banks will have been creating new ways to help control the situation. The most recent expansion by the Fed, for example, included some of the same playbook as Jim said from 2008, but they expanded it quite a bit. And you have now a much wider range. So the market is supported by the central banks in a lot of ways. And the regime shift that I think is happening, and it's maybe unintentional, but is a sort of modern, monetary theory kind of concept where you have a lot of big budget deficits combined with central bank purchasing, and that seems to have kind of caught, been sort of the right approach, or at least been the approach that's been taken by many central banks. So the markets are, somewhat dependent on it in the sense that that is the macro environment that we live in. I don't believe it's going to change anytime soon, but it can create volatility. We saw, for example, at the end of 2018, when the Fed started to pivot and think about changing rates, it was actually a really interesting point in time where you saw a lot of volatility in the markets because of that shift. And that's something that we have to be paying attention to. So, bottom-up underwriting is really important, and I think it's really bread and butter for all of us on the panel. But thinking about the macro environment that we live in is also important, because when it shifts, that creates a lot of volatility and sometimes can create risks that you need to be able to manage.
Jim, sure, go ahead.
Oh, you were about to ask me a question, please.
Well, go ahead if you want to follow up on that one first. But I also wanted to ask you a question about special purpose acquisition company SPACs, right? So we've seen a record level of SPAC issuance this year. You yourself have issued one and de-SPAC'd it. I wanted to get your sense of what's driving the trend, and more importantly for this panel, how do you see it affecting credit markets? But go ahead and follow up on what Joe just said too.
Well, I just wanted to follow that theme. I mean, you've asked us about uneven, unequal, uncertain, and certainly we're all talking about credit and yield around the globe. But I think what has actually been interesting is, as the equity markets have been so focused on growth, there are actually interesting opportunities to find yield in the equity market. And I'm sure there's examples for many of us. But we've found an interesting area in post 1718. There was a lot of yield codes issued, which were public vehicles that would buy utilities that would take off-take contracts from a variety of the utility. And there's one in particular, Clearway Energy, that we've been involved with. But when you look at the metrics and the actual cash flow yield of a company of that nature, it compares very favorably to a investment grade bond or a BBB high yield bond, and has what I would argue is superior yield and strong attachment points for a great business. So I will say that I think there's a big theme, as the equity market is so focused on growth, to find and to harvest yield in a variety of situations. There were other ones in the casino gaming after a lot of the casinos did their restructurings 3-4 years ago. A lot of REITs came out and they owned all the OpCo properties, the PropCo properties. Certainly interesting areas in that as well, in that space. So I just want to say that I think there's a lot of yield in the equity market. To your particular question about SPACs, I think with low rates and high volatility, it's not surprising that investors, especially equity investors, are saying, I can, with a pool of capital that's secured by treasuries, which I get a free look at a acquirer buying a portfolio. It's not surprising that the equity market has rallied around and purchased 40 billion plus or minus of SPACs this year. listen, I think, we talk a lot about it. You're right. We have actually issued, we've de-SPAC, we've done a subsequent issue up at Apollo. We do believe that SPACs will be a tool for a toolbox that fit nicely into the ecosystem of the marketplace. Not every company should be public. Not every company can go public. Certainly, the regulations on doing so have been onerous. And again, with a zero rate world and high equity volatility, it's not surprising that they've sprouted and grown. So, I do think it's going to be as a sophisticated credit investor thinking about how these SPACs finance themselves. If you just do the simple math, if you raise 40 billion this year, think about the pipes that are going to be added to that. Maybe it's 80 billion, and think about equity being 30 to 40%, that's 200, 300, 400 billion of buying power. I do think it is a force to be reckoned with. There will be some of these issuers that find themselves just having hot money and make a bad deal just to put the money to work. Those folks won't come back to the market. But folks that really are thinking about this as an institutionalized product and thinking about how to analyze it and execute it on the equity side as well as on the issuer side, I do think it's going to be a tool in the markets for some time to come.
Thanks, Leslie. So Jim mentioned SPACs as one tool for harvesting yield. As we know, there's an abundance of large pools of capital, almost seemingly endless, from sovereign wealth funds and other large investors that want to invest looking for moderate 6 to 8% returns. How is your firm addressing this need?
I'll get to that in a moment, but first I just wanted to add on to what Jim just said. We certainly echo his sentiments about the SPAC market, and we too have been involved both on the issuer side and on the investor side. And the one other thing I just wanted to mention in that context is how it also in some cases actually dovetails quite interestingly with the credit market, because in certain cases the SPAC market actually allows for companies to actually transition from being over-levered and in difficult position to being ones that have the appropriate amount of leverage and can actually start to thrive and focus on their growth again. And so that's actually another part of the kind of interplay between the credit market and SPACs, and we expect to see that a lot going forward as well. But to touch back on the question that you asked, I wanted to say that an area we're really much more interested in is the private lending space, which Jim had also mentioned earlier. But we believe that this offers compelling risk-adjusted returns. We think we can put a whole lot of capital to work generating mid-teens levered returns for senior well-collateralized loans. As of now, our lending business is as busy as it has been over the last decade. Fortress has been in the lending business since we started in 2002, and it has been one of our most active strategies all along. When you think about the second and third phases of the process of recovery that I discussed earlier, private lending will play a prominent role for us. The bottom line is that companies need cash right now. This is a perfect environment for us to provide that capital. So this is where we choose to focus on the lower end of the return spectrum.
Ilfrin, how is Varde addressing the need for large pools of capital looking for moderate returns?
Yeah, I guess we should all wonder whether 8% is still moderate, shouldn't we? Sitting here with the 5-year rate where it is and high yield spreads where they are, it's obviously wider than high yield and a very significant spread over where treasuries are. And so I would just say wherever we can find good quality yield in the 6 to 8% region, we're really building whole businesses around that. And I think, to echo a really point everyone's made, but certainly one Leslie just made, I think the origination business is really that place right now where you can do it dependably and do it in scale. And the dependability of it really comes down to that point of, I think you've been able to hold returns. You've been able to hold absolute returns post-crisis in a lot of these areas. Maybe you could pull up slide 8 there. Dependably holding returns has been a big deal, obviously, given what's happened to rates. Slide 8, if you could just pull it up for me. And so what we've looked to really do, and I've done this for years, I have to say, is build end-to-end the infrastructure of originating in various, big focus areas in private debt, where you can, both dependably create that return and do it in scale. And of course, part of the spirit of your question is you need to be able to fill this demand in scale. And so we look at that across various different parts of the asset-backed lending space, the corporate lending space. Mentioned a couple of them earlier. The CRE debt space is somewhere where we have a big origination team, and we own everything through from origination through the servicing of those loans. The consumer lending space has been a big focus for us. We own a number of very large consumer lending platforms. And then, the more bespoke origination around our special situations lending business, epitomized by the conversation we had earlier about Asia. And then I will say, look, the traded credit markets at the moment are a very dependable source of what I think is high quality, mid to high single digits and above returns. I think I'll pick up a little bit on the SPAC comment, at least tangentially. I think when you look at the number of business models that are demanding credit and have a high quality business model that's either surviving this or will have new equity come, has strong hands behind it, or has strong shadow hands behind that, be that from the dry powder and private equity, or be that from new sources of equity like the SPAC issuance. There's a lot of ways to get paid a very well downside protected, what we've described here as moderate return in traded credit markets. And so I think, right now there's an awful lot of scale to it. The important thing is to be able to look across those different credit markets and really do it yourself, not just take what the market's offering to you, but also be able to create your own, structure your own, service your own, and ultimately, if things go wrong, work out your own as well. And so that's really the essence of how we approach it.
Thanks. We only have a few minutes left, so we have time for a lightning round, and we'll go in reverse alphabetical order this time. So Jim, we won't discriminate against you this time. Just a simple question and a short answer for this one. What does a post-COVID world look like, right? We're in the middle of it right now. We know there's going to be therapeutics come online. We know there's going to be vaccines come online. Our Faster Cures at the Milken Institute is a website that's been tracking all the different trials over I think it's 300 different treatments and 200 different vaccines. At some point, we're going to get on the back end of this. Jim, what does a post-COVID world look like from a credit market perspective?
Well, I think it's going to, I think post-COVID world, we're probably in a bit more growth. We'll have to deal with some kind of higher rates. I think there's going to be some consumer impact with regards to travel and consumer behavior around the globe. I just think that balance sheets are going to have a COVID risk testing. So regulatory balance sheets are probably going to have a lot more liquidity, and the corporate revolving credit market facilities will probably be impacted to some degree. So that's just a off-the-cuff comment.
Yeah, thanks. Joe, what does a post-COVID world look like to you?
Well, I think you're going to see some of the unevenness probably start to come out of the system. So, I think that's where, growth has been very hot in the equity markets. Maybe value is really going to be the next big shift. High quality companies on the credit side will be terrific. These private credit situations will be, I think, quite good. The outlook for 2021 is quite strong globally. Most economists think, the U.S. is probably in the, at least a 3% GDP. Maybe it's as high as 5%, and some have as high as 6%. So in that context, it's going to be. You asked about the central banks earlier. It'll be interesting to see how rates get, sort of behave in that type of shift from, kind of the depths of the second quarter to much higher growth rate with unemployment, coming down materially, and with a search for yield globally. So it's going to be a very interesting combination and cocktail when some of the uncertainty from the election, for example, comes out, and maybe even with a vaccine. So I think it's going to be equally volatile for the next year, and with a lot of different opportunities in a bunch of different sectors.
Leslie, 30 seconds. What's a post-COVID world look like to you?
Sure. First, I just want to thank you as our moderator and the Milken Institute for putting on this fantastic conference. I would say the vaccine is not a panacea for the economy. What the end of the pandemic will do is increase the number of investable sectors, and it will also allow for the effective restructuring of others that need to see that fallout. So lots of sectors for which we see opportunities for growth, and others where we see a lot of liquidation and reorientation of assets, such as in the world of real estate and retail.
And Ilfred, bring us home.
I'll say something very simple. I think the end of the health crisis and the end of the credit crisis will be very different depending on the industry. I think this thing will take a long time in certain industries to play through beyond the point where we have a health solution, because there's just been so much change and so much damage done in certain industries. So the credit opportunity in a lot of places will extend well beyond the health crisis.
And thank you, Alfred, and thank you all for a wonderful conversation. I started out in the introduction saying that the credit market, was reflecting all the concerns, fears, uncertainties, and realities around both the health effects and the economic effects of the COVID-19 crisis. But what you all have shown is that there are incredible opportunities, and there are specific strategies that you all are employing for the benefit of your investors. And they thank you for that, and we thank you for participating in today's great session. Thank you.
Thanks,
Thank
Mike.
you all.
See ya.